The Momentum Diversified Target Return Fund delivered a strong return of 4.3% over the third quarter, which now brings the fund's year-to-date return to 10% net of all fees. So far, the UK Brexit referendum result hasn't proved to be that global systemic shock that many had predicted. Now, most equity markets, I think, have recovered all or more than the immediate post-referendum falls, with global equities up just shy of 5%, and emerging markets are over 8% higher over the quarter, both of those numbers being in local currency terms. Now, clearly, though, the referendum brought about a short-term knock in confidence, which I think in part explains the Bank of England's decision to cut interest rates by 25 basis points and restart their quantitative easing efforts to the tune of £60 billion in gilt purchases, and for the first time, importantly, £10 billion of corporate debt purchases. Certainly, I think the one immediate impact of the Brexit referendum must be the delay of monetary tightening in the UK into the distant future. Now, the majority of the fund's returns for the quarter were as the result of our asset allocation decisions, and those have been split roughly equally between the decisions we took within the equity component and within the fixed income component of the portfolio. Now, within equities, our emerging market position, which runs at about 6.5% of the portfolio, was the largest single contributor to performance, followed closely by our 12% allocation to developed market equities and our 9% allocation to quality-oriented companies. Now, manager selection within equities enhanced returns further for the quarter. Evenlode, which is our UK quality-oriented manager, performed very well, as did the Jupiter Special Situations Fund, which we use to access European equities, and so did Copernic, our global deep value manager. And then finally, within fixed income, it was really our UK investment grade position, which runs at 7.5% of the fund, that really stood out. We saw falling government yields in the UK, as well as a compression in corporate spreads, which in combination saw one of the strongest quarters for the asset class since 2009. Now, allocations to corporate high yield debt and convertible bonds were also beneficial to performance over the quarter. Now, DTR is relatively cautiously positioned today, with the fund's overall risk at a moderate to cautious level. Now, in terms of our asset allocation policy, we left that broadly unchanged over the quarter, particularly in light of the changes that we made to the portfolio following the Brexit vote in Q2. But I think it's wise, given the continued rise of most asset classes, that we'll be considering paring back some risk further over the coming quarter. Now, within the equity component, we continue to hold positions across developed equities, quality strategies, emerging markets, and a small position in infrastructure. And within the fixed income component, still favoring high yielding credit and convertible bonds. Now, most asset classes have performed well this year, particularly since the sharp sell-off that we saw at the start of the year. But our view remains that the current economic cycle has further to run, and the global economy will continue to grow modestly. But I think it's the effectiveness of this ultra-loose monetary policy that's increasingly being called into question, as well as the risk that future asset bubbles could have on the financial system. So for now, we will maintain broadly the overall level of risk within the portfolio, as we believe that some short-term concern is warranted. Although I think ultimately a combination of more monetary and fiscal accommodation should provide support for financial assets going forward.